Negative rates is one thing when you're trying to save and you have to pay the bank for the honor of them holding your money. It's another thing if you owe money. In Denmark, they have 20-year mortgages that have attached negative rates. In other words, you're doing okay. Potomac Wealth Advisors President Mark Avalon, on whether this trend picks up steam here. What do you think?
Well, I think surprisingly the 10 years back to as low as near its lows of all time, at least what we saw in this past cycle, and we think that that's going to continue. The U.S. cannot continue to have rates that are significantly higher than overseas. There's just too much of a currency differential. Foreign countries are using it for trade advantage, and I think that the rates here are going to continue to decline to be more in global balance.
So what would that mean if you take out a mortgage and this is the same phenomenon? How does that work?
Well, it's going to benefit people who are borrowing, and it's going to hurt people who are saving.
Right.
And the people who are saving are then going to be forced to take more risk, and more risk means higher allocation to junk bonds, lower quality bonds, more stocks for retirees, and that creates risk. Sure, the people who are borrowing at the bank, that puts more cash in their pocket, can be more stimulative to the economy, but on a net basis, eventually there's a tipping point, and we're getting close to it.
Mark, this is Deneen Borelli. So this, to me, the negative loan sounds counterintuitive. It's like the bank is paying you to take out the loan. But perhaps the thought is that they would provide more loans to people by doing so. But what about those whose credit rating isn't so great? Would they be more at risk to not be able to get a loan, if that makes any sense?
Yeah, well, credit risk is always a factor in the availability of credit. That's not going to change because the term structure of rates is lower. What it's going to do is it's going to encourage more people to take on debt, or at least buy a home in the case that you're citing, which the desire from these central banking groups is that it's stimulative to the economy. When in reality, what they could do to stimulate bank lending would be to reduce bank regulation, maybe reduce bank capital requirements, and give them more incentive to make loans and have a growth and demand-driven, more organic-driven economic recovery, as opposed to saying, here's cheap money, go borrow some. That's where I think they're missing the boat, especially overseas in Europe at the European Central Bank.
Who wouldn't want to sign up for that?
Well, I want to raise an issue, too. I think it's very important. Mark brings this up, John Lonsky here speaking, and that is that you cannot look at price-earnings ratios without also considering the level of interest rates. I think some have the problem, they look at a very high PE ratio for the equity market, historically high, but they overlook the fact that one of the reasons why the PE ratio is so steep is because interest rates are at historical lows, and there's a reasonable chance that interest rates may remain low well into the future, if only because of unprecedented demographic change, where never before has the U.S. economy, will it age in the same way that it will over the next 10 years.
Well, what's happening, and that's right. When you're looking at these low rates on bond yields, you're forcing people to make decisions and say, well, stocks are reasonably valued, they're more attractive, even though the historical forward PE is at full valuation, maybe even inching a little higher these days. So you're forcing people who otherwise would not absorb stock risk into the stock arena. It's also, just as importantly, forcing them to buy lower quality bonds. Many people don't know what they're getting when they're in an income fund and how much junk bond is in there, what emerging market debt is in there. They're not understanding the underlying mechanics, and they're taking on more risk just to generate adequate income or retirement cash flow.
And, you're making an important point. If I was an individual investor and I was looking at corporate bonds, maybe I would want to have a well-diversified portfolio of BBB rated bonds. You want to go into high yield. Make sure you have plenty of diversity in your portfolio, because eventually there's going to be a recession, profits will contract, and that high yield default rate is going to soar above 10% and at least leave you stuck with some pretty deep temporary losses.
Yes, and for now, being in the U.S. high yield market, where I think it's a relatively safe place to be for now, but that could change, of course. Without a recession on the horizon, I don't anticipate an immediate surge in defaults of high yield bonds. So people that are stretching for yield are getting a sense of false comfort when you look out to the inevitable economic cycles, which do ultimately include a recession and a pullback. And when that happens, high yield bonds will take a hit.
You know, Max, you raised an interesting point during the break. I mean, what happens to people who save for a home? There's no need to do that right now. If you're, a bank is entering a mortgage with you,
Yeah.
right? It changes the dynamic.
Yeah, I mean, I don't see why I would take $60,000 or something of my own money and put a down payment when I can borrow that and then pay less. What concerns me is what happens.
Like a Republican.
I'm so sorry. What concerns me is what happens even if you're locked into this negative rate. When rates go up more broadly, that's going to have a downward pressure effect on housing prices. So even if I'm locked into a cheaper mortgage, I may not be getting back what I put in to buy my more expensive house.
No, that's a good point. But go ahead, finish that point, Mark.
But that's a risk, and whenever you take a loan out, that's a risk that whether you're paying interest or not, that at the end of the day, the value is going to hold relative to movements in rates, and certainly a higher interest rate structure is going to put downward pressure on stock price, on housing prices. Look, I think if you can't afford the cash flow and you can't afford the payment, some of these gimmicks should be ignored. I think the underlying factor here that investors need to realize is there's deep trouble over in Europe. They're giving money away, and they need to take deeper structural reforms in order to resurrect that economy, especially relative to the U.S., which continues to be stronger on a relative basis.
All right, a flight to quality here. All right, Mark, thank you very, very much. You might have heard Mark and others mentioning about how in a very low zero